Why ETH?
So Ethereum is very unique because it is on the precipice of becoming what we like to say is globalization grade technology.
Ethereum is entering a new phase where institutions participate, money moves at scale, and regulators begin to watch closely. That's when technology becomes truly global.
We all see what is happening in the tokenization space with the institutional race to adopt on-chain solutions, and Ethereum is in pole position to capture the supermajority of that flow.
When it comes to actually tokenizing finance, when it comes to tokenizing money markets versus actual real assets which have illiquidity crisis, so where do you see the adoption happening in the first phase?
So I think that what we've seen so far is tokenization of money markets because it's the lowest duration, most accessible vehicle for someone to prove of concept, but it also solves a very real problem, which is a lot of money sitting on the sidelines isn't generating yield.
In the next coming days, I think Crypto Clarity Act or the Crypto Market Structure Bill is definitely one being the debated the most. Do you really see these geopolitical events plus these crypto bills actually kind of being, let's say, do or die situation?
So I definitely view it as a milestone, and I think that the milestone will probably feel anticlimactic in the moment because we've built it up so much. But in reality, it's going to be a seismic shift behind the scenes for a lot of institutions.
Hello everyone, how are you? Welcome to yet another episode of Voice of Web3 powered by CoinGape Media. Yeah, guys, again, as we always discuss, crypto is becoming more and more mysterious as the days are passing by. We are hearing so much in the geopolitical arena with regards to tariffs, with regards to the new crypto bills, with regards to fundamentally stable coins and the changing equation of various cryptocurrencies. So, guys, just like every time today also we have a very special guest today on our podcast. We have invited somebody who you have been requesting for so long now. You have been requesting us to bring somebody from the DAT side of things to understand what on the Wall Street is going on, why companies are now trying to accumulate more and more cryptocurrencies. To that end, guys, today we have somebody very special on the podcast. Today we have Matt Sheffield, guys. He's the Chief Investment Officer at Sharplink Gaming. Sharplink is a company, if you remember, one of the first companies to actually create ETH Treasury. He oversees capital allocation and digital asset strategy over at Sharplink. He brings deep experience across traditional finance and crypto, having previously held senior roles at Bridgewater Associates and Falcon X. These are also one of the largest institutional crypto brokerage firms. Matt is widely followed for his insights on macro markets, liquidity, and institutional adoption of digital assets, particularly around Ethereum and tokenization infrastructure. And we all understand what kind of buzz tokenization and DATs are already creating. So, Matt, welcome to the podcast. Welcome to Voice of Web3. How are you?
Doing well. Thanks for having me.
So, Matt, of course, I mean, we have a lot of questions for you. DATs still is a very big puzzle for the retail investors to understand. As I was just discussing with you backstage, the average age group still in crypto is quite low. So let's say 20 to 30. And whatever is going on Wall Street is a big mystery. To that end, today we will try to demystify some of those. So, Matt, welcome to the podcast. How are you?
Doing great. I'm really looking forward to this conversation. I agree. There's a lot of interesting things going on, but it needs to be explained to the broader market. I think those that spend their entire day following the industry have just enough time to keep up with a small portion of what is actually happening. And for everyone else, there needs to be high quality recaps and these types of discourses.
So, Matt, one of the first questions even we have, and I'm sure everybody has, because Sharplink traditionally was not a crypto company. It was not a crypto native company. It's a company that was very well rooted into gaming ecosystem, gaming solutions. And it could have created a DAT out of any crypto. It could have been XRP, it could have been Solana, it could have been even Bitcoin. So why Ethereum, Matt? I mean, that's a very big question, and hopefully you can help us understand why ETH.
So Ethereum is very unique because it is on the precipice of becoming what we like to say is globalization grade technology. We all see what is happening in the tokenization space with the institutional race to adopt on-chain solutions. And Ethereum is in pole position to capture the supermajority of that flow. It was already the largest chain across a number of real-world asset metrics, stablecoin adoption, payment transmissions, etc. But it's also where we see a lot of the largest institutions, the JP Morgans of the world, the Fidelities of the world, the BlackRocks of the world, trusting their future adoption plans because it is truly decentralized and it is always focused on the hardest parts first, which is security and cryptographic expertise. And that's really important. And so when we looked at where is there a generational opportunity that's not yet being priced in the market, Ethereum was the clear choice. And the second thing is because it's a productive asset. You know, Michael Saylor obviously pioneered putting crypto on a public market balance sheet, but Bitcoin is, you know, digital gold, a store of value. It doesn't have native productivity. The yield is financialized yield, and we can talk about that a bit later. Ethereum has native productivity and it becomes more productive in the right hands. And that was a big differentiator for us. And so our chairman, who was the co-founder of Ethereum and the CEO of Consensus, Joe Lubin, he ultimately had this vision and worked with Sharplink to adopt this Ethereum strategy. And in, you know, the time since, we've accumulated about $2.6 billion worth of Ethereum.
So, Matt, I mean, and this may sound very naive, but we represent retail investors, and believe me, everything that you will share today is kind of information for us. Okay. So, I mean, we do understand the part where a company wants to accumulate a particular good cryptocurrency. They want to hold it as an asset of value. But what other than that? Why Sharplink wants to, let's say, accumulate ETH, number one? And secondly, what's the ultimate goal here? What's the purpose of accumulating so much of ETH?
Yeah. So at the end of the day, all companies have the same goal: maximize shareholder value through time. What we've done as a Ethereum treasury is essentially add one additional step to that, where we've said our thesis is that Ethereum is a generational wealth creation opportunity. And so we are going to optimize for getting as much Ethereum per share on our balance sheet, because then we believe that will maximize shareholder value through time when you go and denominate it in fiat dollars. So by adding that extra step, we're still optimizing for maximizing shareholder value through time, but we've made the decision accumulation of Ethereum per share is the optimal way to do that. And we want people to have an option to go out there and say, okay, great, there's a company that's aligned with that thesis. I'm not looking to purely accumulate dollar wealth directly. I'm looking to accumulate as much Ethereum so that that can grow my dollar wealth through time, because I think Ethereum is going to appreciate. And it's that extra step that makes DATs important, because there is no other way to take that type of view and make it productive currently.
Mm-hmm. So, Matt, I mean, if somebody today who is a shareholder and holds Sharplink shares, let's say, what sort of message or what sort of value do they get out of this? I mean, you are saying that essentially you are increasing Ethereum per share. So if in case future this ETH is staked or there is some form of yield on this ETH, does that project into the shareholder value as well?
So that is our explicit North Star: maximize ETH per share. And so if you hold a share of Sharplink, our goal is through time that you generate additional ETH denominated wealth. And then in turn, because we believe that ETH is materially underpriced through time, that also leads to dollar denominated wealth. And so we like to think of it as you've already made a decision that you want to be invested in Ethereum. That is your beta that you've chosen already, right? We are looking to be the alpha on top of that. We are a company going out there every day trying to generate additional Ethereum wealth, no different than how most other companies in the world go out every day trying to generate dollar wealth. The only extra step we've added is, instead of directly saying dollar wealth, we're going to go and try to generate more Ethereum for our shareholders, and that we believe that in turn will generate even more dollar wealth. So it's a very active style, as opposed to, you know, buying and just staking yourself. That's on the more passive side. Buying an ETF, extremely passive. We want to take active productivity and make it mainstream, make it publicly available, and make it liquid in the public wrapper.
All right, all right. So I mean, right now, ETH, the purpose it is serving is more about store of value, as against, let's say, something to do with the blockchain or the programming part of it, right?
So actually, in the case of Sharplink, we already are making the Ethereum productive, and we continue to do new deployments to make it more maximally productive. So we've done deals where we are doing restaking, and I know we're going to talk about that potentially a bit later. We're doing deals, OTC deals, to generate additional yield incentives on top of it. The more productive you make ETH, the more you can generate on a risk-adjusted basis in ETH-denominated terms. And so we don't want that to just be an accumulation vehicle, buy and hold. It really is about spending all of our time on how to take the existing ETH balance sheet and generate additional value on top of it for the shareholders. So same goal as any other company, just denominated in ETH. And that's where I think the big difference comes for a company like Sharplink and most of the other DATs out there, is we're not trying to be a passive play. We truly want to be seen as the active productivity firm. And that's basically our North Star.
So, I mean, given there is so much of hype right now around blockchain related products or services, for example, tokenization is right now the buzz of the town. Everybody wants to bring their assets on chain. And we understand that, yes, but liquidity is still in crisis. There is no clarity on the other side that how these tokenized assets will actually get liquidity. So to that end, what sort of future you see for DATs? I mean, of course, right now there is a competition. Everybody wants to accumulate as much as Ethereum possible. But how do you see playing this out in, let's say, next 5 years or 10 years?
So I think that DATs have the potential to be extremely impactful players in the ecosystem, because we're taking longer term views on growth, on investment, on deployments. So, an example that I was mentioning earlier, we did a deployment, a restaking deployment with our partners at EtherFi, EigenCloud, and Linea. In that deployment, we agreed to a multi-year commitment for $200 million worth of deployment here. That is a pretty considerable amount of time for crypto. I think we're all very used to, if you actively manage your personal account, that a lot of the incentives that are from inflationary tokens on new protocols, they are basically VC funded 1 to 3 month incentives. You go and farm them. When those dry up, you go and move on to the next opportunity, and TVL drops off a cliff. It looks like a shark fin, right? And that's not very productive for large institutional adoption. Like you said, liquidity is a big problem. You need to have some consistency, some duration. And so that is something where I think DATs can act like a different type of player, because we're willing to take multi-year bets, because we've already made this decision. We know Ethereum is a generational opportunity. Our capital is in for the long run. We have a lot of institutional investors who are making these not for the next 2 or 3 months like a trade. These are multi-year, maybe even decade-long commitments that they're making to the Ethereum ecosystem. And so we can also in turn make these longer-term commitments that the space has been so craved for, but we're still doing it through a capitalist lens. And at the end of the day, I do think you need a capitalist lens for productivity. It's fantastic when you have foundations that are doing things for the betterment of an ecosystem, but we like to consider ourselves benevolent capitalists. We're here to make shareholders money, but obviously we own a lot of Ethereum. We also want to do things that are good for the Ethereum ecosystem. The marriage of those two, we think, is the right balance to really be productive. And we can talk more about RWA liquidity, because I think that's a very interesting problem set of how you kind of bootstrap that off the ground.
Yeah, I mean, so even ourselves, even we, I mean, as a player in the space, we have been getting so many requests from large family businesses, HNIs, who have these assets which ideally are not doing anything. They are just there, right, on the balance sheet. It is not generating any revenue, and it is not giving any value output in a sense. But while we are tokenizing these, of course, for these clients, we are also right now thinking that, okay, how do companies in DATs, how do these large, essentially holders of these cryptocurrencies are going to support on the liquidity side? Is there a demand you see for the RWA as well in the coming future from the DAT side of things?
I do. So where I think the RWAs fit in is we all think that RWAs are obviously huge opportunities, and the banks are speaking for themselves on that front with the rate that they're announcing tokenization efforts, are actually taking the actions themselves. The important thing is that the DATs are holder of, in our case, Ethereum. We're not holders of like these dollar liability assets like RWA credit, et cetera. But what we can do is empower the liquidity on chain to make it more productive to hold the same asset on chain than it is to hold it off chain, right? Like you can see a world in which DATs are significant participants in collateralized lending markets. Maybe you could borrow Ethereum against your RWA. Once you start to then have legitimate lending markets, which obviously needs to be supported by realistic prices on the AMMs, or at a minimum, there's a very good Oracle 24/7 that is able to support that. You potentially make it more effective and productive as a shareholder or as an RWA holder to have that on chain than off chain. And that value flows back to the asset off chain. And as a result, it becomes a virtue cycle. So imagine a world where you're holding your tokenized Apple and you're able to go and borrow against it at reasonable collateral levels in Aave, Lido, et cetera. And then you go and say, I'm going to go and do that deployment, and I'm going to take that and put that into a vault, low yielding, but it's positive carry. Fantastic trade. If you're earning an extra 4 to 6% as a result of that, what relative to what you would have gotten at your brokerage, where most of retail gets a small fraction of the securities lending income. Well, now that security is worth a lot more to you than it was before. And what happens there? The borrow rates in the security itself off chain potentially go up because you can generate more yield on chain. So someone borrows it, tokenizes it. That pushes the value of holding the long ownership in that security up. You've just made that a better asset than it was before. And as a result, value flows through to the entire shareholder ecosystem, whether you're on chain or off chain. So I think there's a huge amount of opportunity, but there's a cold start problem. Until there's liquidity, it's hard to get more liquidity. And so that's what the industry is wrestling with.
Yeah, I mean, so ownership transfer still remains to be a challenge we see from the regulator side, because most of the RWA tokens or currencies today, if you see, they are more or less a derived version of the asset. So the token may be representing, let's say, the appreciation part of the asset, or maybe the yield part of the asset. But we are still kind of not seeing a lot of assets which actually represent an ownership transfer. I mean, in UAE, we have seen some cases. We are seeing some cases in Saint Grenadines SVG as well. But I guess regulators are still trying to catch up on that part.
Yeah, I think it's actually very typical in crypto for you to see derived assets before you see the actual. Liquidity is, generally speaking, easier to bootstrap in derived assets because it's more capital efficient. There's less settlement barriers, et cetera. It's the reason why we see perpetual markets often deeper earlier on in a token launch on a Binance, OKX, or Bybit, just because it requires you to just have any sort of hard collateral like Bitcoin, ETH, or USDT on exchange. It doesn't require that you always have inventory in the underlying. So it's easier for that cold start problem to market make. Similarly, I do think that the derived real world assets are slightly easier to cold start because of that ability to hedge in one place and then be able to provide liquidity in another. It still ultimately leaves a goal of getting to the actual security being the thing that is liquid and tradable. But it also creates a huge opportunity because you can now quantify the benefit of the security ownership versus the derivative ownership. So in the same way that Ethereum, Solana, anything that has a native staking yield, the perpetuals trade at usually lower funding rates than Bitcoin. That exact same concept might apply. You're like, okay, great. What is the value of my vote, for example? Maybe there's a massive shareholder vote coming up. So you could long the security version would be more expensive than long the derivative version. There's a spread between those two. At this point, it's a bit more theoretical, but I do see a world where both of them can coexist and actually help to basically create a more liquid ecosystem in the aggregate by trading off one another.
I just wanted to kind of touch upon one last question in the same discussion, because I saw somebody, so there is a kind of an environment right now where you see a lot of Wall Street faces now in crypto as compared to 3 years back or 5 years back. And there is an ongoing debate right now that what is going to happen to so many of utility tokens that exist on Binance, Coinbase, and these exchanges, which had large market caps last year. I mean, so we have seen tokens, coins, which were having a lot of utility to go down, let's say 70 or 80%. And some of them seem to be they are not going to recover. Now, so there seems to be a debate right now that okay, Wall Street is there, but what is going to happen to so many of cryptocurrencies that exist today? And to that end, my question actually is, I recently saw somebody posting on LinkedIn, and they said that okay, tokenization is all about money markets. Tokenization is all about tokenizing money markets, finance first, and then maybe the real estate or the real world part comes later on. So I wanted to kind of get your points on it, that when it comes to actually tokenizing finance, when it comes to tokenizing money markets versus actual real assets which have illiquidity crisis, so where do you see the adoption happening in the first phase, let's say next 5 years?
So I think that what we've seen so far is tokenization of money markets because it's the lowest duration, most accessible vehicle for someone to proof of concept, but it also solves a very real problem, which is a lot of money sitting on the sidelines isn't generating yield. But if you want it to be transferable or make it productive, you previously had settlement timelines, you had a lot of frictions in the ecosystem. So I think tokenized money markets were just the first manifestation of RWAs that became really mainstream because it solved a need and was also like a nice way to kind of test the waters, build out the infra, et cetera. I don't think that that's necessarily where RWAs are going to kind of peak in terms of usage. I truly think that tokenized equities will probably be one of the largest use cases just because the amount of volume that goes through is already pretty considerable, but the amount of utility that is being left on the table by not ensuring it gets to the participant that can makes it maximally productive in the lending markets. There's a lot of frictions and a lot of hands that have to take a piece of the pie before it gets there. So a lot of yield is left on the table, and it's a pretty easy use case. The less liquid assets, I think, will have a place on chain without a doubt, but it still doesn't necessarily mean that they become, order of magnitude more liquid because you still need market participants who have a reason to want to trade it. What it might do, though, is it might allow more people to get access to them. It might allow more fractional ownership in smaller quantities. It might allow people to start curating index strategies, vaults, et cetera, that take advantage of them, increasing the velocity of their trading, and that could potentially make them more liquid. I think that's not the primary use case because it's still very difficult for someone to, let's say, create a lending market around something that doesn't trade very often. What would you use as your oracle price or, your liquidation threshold? But I do think that that is what we're marching to. Like everything is more liquid if you have a larger network of participants. The less gates you have in between each participant, the more people who have the ability to trade the same asset, touch the same asset, et cetera. And so all else equal, I think that's what we're marching to. We're just going to do it in like an ascending order of difficulty, duration, and liquidity. So tokenized equities probably next, probably bond funds as well. Then you go into like indices-based credit. Then you probably go into single name credit. And then you probably get to a world where like individual currently considered illiquid assets, and I would consider residential real estate to be in that category, right? When you look at broker spreads and the way that you have to go and sell it, like you're listing it on websites, you're going to realtors. Those are probably later down the line from like a trading perspective. People might tokenize for ease of transfer of the deed and things like that. But until we actually have like liquid marketplaces and like systematic ways to evaluate it, I don't think that those actually become tradable. And that's what I think Wall Street is really pushing towards. They see the amount of friction and inefficiencies in their existing system, and they see how strong Ethereum can be for creating a larger network effect where everyone talks to each other.
So, I mean, you must have also seen the recent update that New York Stock Exchange also is going to introduce tokenized stocks. And that was something which earlier, I mean, people like me were thinking that, okay, this is something, the liquidity is a part that I think ultimately the blockchain will bring. So for example, DEXs on Ethereum or the existing network base, investor base of Ethereum will provide that liquidity to any RWA that onboards onto Ethereum. But the recent announcement kind of, changed that. And now I see these blockchains competing with these regulated exchanges, competing with these, let's say, regulated third parties. Do you have any point to that? Because earlier I was thinking, okay, if let's say I have an RWA, I'm going to launch it on Ethereum, and I'm going to use the liquidity on the various DEXs, which are right now very popular. So do you also see this kind of a problem or a choice tomorrow for investors? I mean that it's going to again be something about DEXs versus regulated exchanges?
So I think going back to the, derivative version versus the security version of the tokenized equities point, this will create an opportunity to help bootstrap liquidity in the rest of the ecosystem. So the exchanges have generally solved the problem of the cold start, right? Like when someone IPOs, the stock is liquid enough to trade. That is like the most important part of the process. And they take it very seriously. You interview exchanges, you know that they have designated market makers in place. It's a very regulated ecosystem, but there's also a high quality that you get when you go onto a regulated exchange because they've been doing it for so long. If they're releasing a product in tokenized equity space, I can almost guarantee that they're going to put the same level of rigor into that launch as they would to any other launch. And therefore, I think you'll have some of the largest market makers in the world who may not have yet really focused in large part on digital assets because the TAM wasn't there and they see it as emerging. Will probably be getting involved in the near future, but we haven't previously had a need to grow a massive desk out. Those household names are probably going to now need to build the systems to get on chain. And once they have the systems in place, why wouldn't they market make on the venues that we already have, right? Like there's an economy of scale. So that cold start problem, it applies to institutions too. You need something big enough, a big ticket thing to get them to build all the infra, compliance, oversight for digital assets. From there, it's a natural segue for them to expand into the ecosystem we already have. I think it's actually going to be great for the existing ecosystem. Like why wouldn't someone go and borrow on a lending pool if the cost of capital is lower, even if they're going to go and market make on a regulated venue? If the cost of capital is lower somewhere else in the EVM world, it would not make sense for a trader to live outside of that. Like you're always going to do the thing that's the most productive. That's the great thing about markets. The efficiencies find themselves and we all work towards it. So I'm actually very excited for it. I thought that announcement was really bullish for the ecosystem because we have other people focus on the cold start problem that was more so a crypto native problem up to date.
And Matt, what about these private blockchains? I mean, every now and then you are seeing banks announcing that they are going to launch their own blockchains now. You are seeing a lot of enterprises and private companies as well getting into these announcements that, okay, we are going to launch our own blockchain. So, I mean, how do you see this in an overall scenario where we are talking about Ethereum as an ecosystem? Do you see these as a competition or as a positive news for Ethereum?
I don't see it as competition. I see it as long-term positive, short-term neutral, because ultimately a private blockchain, they're just saying that they're building internal infrastructure for their clients to utilize. They've been doing that for the longest time. They just weren't building it on blockchain. At the end of the day, going back to the adoption problem, I would rather have companies building blockchain oversight systems, blockchain trading systems, etc., even if it's not on Ethereum day one, because it still means that they are focused on the right problems. And then it becomes a lot easier for someone to go internally and pitch, okay, great. Once again, I see better utility out in the world of EVM than in our own permission chain. Maybe my first phrase, can I just be a net borrower? And then it's like, okay, great. I'm not looking to fully integrate us yet. I know we're a conservative financial institution, but we have all this excess cash that we're holding overnight. Can I go and lend it into, well, like Vitalik would say is safe DeFi. Like let's do extremely over collateralized, well-tested pools. But that first foray, having it be something that all of management is bought into and maybe de-risk them because it's a private blockchain, that's great. It doesn't do anything for Ethereum today, other than increase the future value of the expected number of market participants, because we're just now a half hop away from them being fully compatible and integrated.
Yeah, Matt, thanks a lot for this discussion on RWA. And I'm sure next time we will call you upon and we will have a separate discussion on tokenization and RWA. But
Absolutely.
Matt, so a lot of people have asked us this question, and it might be a bit, let's say, controversial as well. But as an investor, if today I'm making a choice where I can invest either in the share, in the stock, SBET, or I can invest directly into Ethereum, So how do I make that choice today? So for example, I'm trying to either I have money, I want to invest, but I'm trying to make a very cautious and very wise decision that what should be my choice today? Should it be Sharplink stock or should it be, let's say, Ethereum itself, native Ethereum?
I think the best metaphor for this is if you have gold, which congratulations, that's done very well lately. Hopefully you have silver as well. You
I'm
could
still
have
holding Ethereum. Oh, no.
exactly.
We're in the same boat. We are in the same boat.
If you have that, you can go and put it in, let's say, a bank safe, lock away the key. And when the time comes, if you ever do want to go and realize the wealth from that, you can go and get it out. You will have exactly how much you originally put in there. Or if there was an option for you to go and say, let me take some of my gold, not all of it. You should never put all of anything anywhere. There should always be diversification of custody, diversification of service providers, but it's a bit of a tangent. And you could give that gold from the safe to a company that said, I am going to try to turn this gold into more productive gold. And my goal is to, through time, generate more gold in a risk adjusted way, in a low risk, predictable way. Like our goal is to be an ETH denominated wealth accumulation vehicle. It's just a different play than buying something and putting it under the mattress. There's certainly nothing wrong with that. I actually recommend that everyone with a portion of their crypto has it in cold storage or a custodian that you know and trust, preferably multiple. But I personally like that I can make my Ethereum more productive every day. And that's the goal, because otherwise you're missing out on a huge opportunity cost. Other people are generating productivity. You're not. If you can outperform through time, we've all seen what compounding interest can do for someone over a period of time. Even if you compare it to an ETF, right? Like an ETF might be the safest linear play. But if you compare an ETF that is allowed to stake 50 to 70%, but has, fees that probably bring your net staking yield to 1.5%, versus just being able to capture the full Ethereum staking rate. So Sharplink has been staking 98% since day one. Now we're doing things that increase the productivity and yield beyond that. But since day one, we've been staking 98%. That right there is a 1.5% difference of the headline rate of like Caesar versus what your net return would be on an ETF holding roughly 50 to 70% staked. That compounds considerably over time. So if you're making long-term investment decisions, just think, what would you do with your dollars? And then think of DATs as just companies who have decided to denominate in your chosen asset, not in dollars. And think of your portfolio the exact same way. I would never tell someone, buy our stock, don't buy our stock. Everyone has different risk tolerances. I will say, generally, if you're already investing in crypto, you're on the side like me where you have a bit more of a risk tolerance for your portfolio. But everyone still should build a balanced portfolio and make those assessments that suits their needs.
So, yeah, I mean, we have seen these comparisons now quite a lot where a DAT has constantly been compared with the underlying asset. Yeah. And MicroStrategy seems to be one that is discussed the most there. That why MicroStrategy stock outperforming Bitcoin, or is it underperforming Bitcoin? And I'm sure these discussions and these comparisons will keep on going on. Now, to that discussion, I mean, today, how I see that you are trying to kind of treat Ethereum like an asset. If in case tomorrow it delivers more value, more output, the underlying asset as well as the company kind of grows more and more. So if I were to say that investing in Ethereum is far more riskier as compared to SBET, am I right there?
It's hard for me to make that kind of assessment because it's a different investment. I would almost think of it as like we want to have as much ETH per share through time as possible. So if you want to be long Ethereum, being long SBET, we are holding Ethereum as the super majority of our balance sheet. That being said, they're different investments, no different than putting your dollars into a money market fund versus investing dollars in a company that you think will make those dollars more productive. They just live in different parts of the portfolio. That's all. There is a world in which you could say it's risky to not make your money productive, right? Like it's risky to put your money under a mattress in its entirety because you're going to wake up 10 years from now and your buying power will be a lot less than people who potentially made riskier investments if those things went well. So it's just a risk reward conversation. I think it all goes back to You should build balanced portfolios that reflect your needs, but also your risk tolerance. The worst thing is to be in a position where you're staring at what you're holding constantly. Every tick is making you sweat, because that's when you make decisions that probably don't work out for the long run. You're going to make overly emotional trading decisions. So do whatever you'll be able to sleep the best at night with for your portfolio, because we are a long-term play and we are thinking in years, not in days.
Yeah, so we recently had the Bitwise CEO, CIO as well, and we were having discussions with him as well. And this was his advice as well, that if you should have a kind of a patience scale of at least 10 to 15 years. If you are trying to hold these cryptocurrencies, you need to see it work out. So, the first chance was getting in early, and this is also in a way the second kind of a cycle, and it's still very early if in case we treat them as assets actually.
We are so early. If you look at where we are in adoption, most institutions have done nothing, at most announced. In a few select cases, people are dipping their toe in. When you look at the size of real world assets relative to the financial universe that exists, you can barely see the dot in the chart. That is how small and how early we are. And so I think, sometimes saying we are early can be a bit of a crypto echo chamber sentiment. But when it comes to institutional adoption, the metrics speak for themselves on that front.
So, Matt, right now, since Donald Trump became the president, United States president, we saw crypto actually kind of, we are getting a lot of clarity when it comes to regulations in US after Mr. President taking presidency. And we are seeing a lot of these bills being discussed. We are seeing a lot of updates and a lot of market a lot of market going up and down as well because of these updates. On a daily basis, we are seeing it. And specifically speaking, the dump on 10th of October, it was very disastrous. A lot of people lost their money. And later on, we came to know that it was just a miscalculation. It was just kind of a miscalculated tweet, which was reiterated later on. But it led to quite, as far as we estimate, it was around more than 100 billion worth of losses that people took that day in a single day. And right now we are seeing a lot of events being lined up that again we speculate that will kind of pave the future for crypto. And I wanted to take your your points on that how you see these playing out. So in the next coming days, I think Crypto Clarity Act or the Crypto Market Structure Bill is definitely one being debated the most. Do you really see these geopolitical events plus these crypto bills actually kind of being, let's say, do or die situation, or do you see this just as a phase which is gonna pass?
So I definitely view it as a milestone, and I think that the milestone will probably feel anticlimactic in the moment because we've built it up so much. But in reality, it's going to be a seismic shift behind the scenes for a lot of institutions. So what I mean by that is that for a long time, honestly, until very recently, holding crypto on your balance sheet or putting it into your portfolio as an institutional investor was considered a career risk. Pensions, endowments, banks, you didn't spend 30, 40 years building your career, finally getting to a place where you have the ability to make these large decisions, to risk it all on what you were considering a 1% to 3% investment, right? Even though that 1% to 3% is a massive amount of dollars in the grand scheme of crypto's market cap, it's not the most important part of your overall business. It is now becoming extremely risky to not put crypto on your balance sheet as you see all of these other competitors in the landscape trying to one-up you and ensure that they are in pole position. The Clarity Act de-risks that trade for a lot of institutions. They've been waiting for someone to say, it is okay, here are the rules, here's how it's going to be regulated, you are okay to proceed. Until that happens, actually going and deploying is still more of a career risk. The moment that happens, everyone now can go and say, great, we're building to this. We know all of our competitors are building, and I no longer have the same career risk of doing it. It becomes risky not to do it. That's the shift that I think happens. And so you're already seeing the headlines building, people announcing we are going to deploy Q1, Q2, Q3. I mean, the headlines are nonstop. We see it all the time from some of the largest financial institutions, some of which were very publicly anti-crypto as recently as 12 months ago, are leading the way. That exact dynamic is what is happening at every level of management at these firms. It's just less risky once the Clarity Act comes out for you to go and make these decisions. So I think you're going to see a lot of capital expenditures going into building crypto related systems, getting into tokenization, all really get announced and kick off once the Clarity Act is in place. And when we look back at like an elongated timeline, if you mark where the Clarity Act is, the rapidity of like change in the institutional public posture and deployments will be considerable in the months after Clarity Act, is my view.
So, I mean, in the Clarity Act, it is general knowledge by now that there is a debate between banks versus the crypto institutions, that who gets to control the yield part of the stable coins, who gets to provide their customers this control that, okay, you can get an interest on your stable coins, you can get a yield out of it. And Ethereum, since it still hosts the largest stable coins, the largest stable coin transactions still happen on Ethereum. So Ethereum seems to be in the middle of that kind of a debate. So, I mean, if in case this happens that, okay, banks become the ultimate beneficiary of this debate of the Clarity Act, do you see it? I mean, it as a very bad news for crypto. I mean, if in case banks do get that control.
Banks already have that control, and banks are the ones that spend a lot to lobby to maintain that control, which is why I think you see so much scrambling from all these institutions to release their own stablecoins, because they were caught off sides by all of this. They knew that eventually they were going to get into crypto. They didn't think it was going to happen this quickly. They didn't know that the administration was going to prioritize becoming a crypto powerhouse as a country so quickly, and they weren't ready. And so what's the next best defense you have if you're not ready? It's to leverage your existing political power to try to slow down the incumbents who would benefit while you build something that would benefit in its stead. So I have no doubt that we are going to eventually be able to fully realize the yield and benefit on chain. It's simply that if the banks are successful, it's to add a speed bump while they get their own stable coins and infrastructure in place so that they're the beneficiary and not the crypto incumbents. Ultimately, when you have a competitive marketplace, the consumer benefits the most. That's what decentralization offers best. And so I do think it will become untenable for people not to offer yield. You know, there's many ways that people currently get yield from stable coins. It's considered rewards, or you have to go and put it into a staked version of the token if you want to be able to realize the benefit. It's not like people are leaving all the yield on the table today. You just have to make it consumer friendly, and that would ideally be that you get the yield in the token itself. I think the banks just have to go and get their stable coins into production first before they say, okay, fine, you've twisted my arm, let's do this.
Right. I mean, people anyways today utilize Aave or other DeFi protocols. You can go there and stake your Ethereum or Bitcoin, and you can easily kind of lend and borrow stable coins, essentially. And I do see when I talk to our counterparts in the banking industry that they seem to not even be aware that there is something called Aave somewhere, and that again makes me think that, okay, we are still, when it comes to stable coins or let's say even treasuries, it's okay. But as soon as we start this box called DeFi, it becomes too complicated again. And Ethereum soon seems to have a lot of strength from there only. So I wanted to get your thoughts on DeFi as well. I mean, do you really see regulated third parties like banks again regulating this whole DeFi space, or do you still see that players like Aave and others will actually have a say in this even when Clarity Act is passed? Because right now Clarity Act seems to be giving a lot of power to institutions and regulated institutions again, where Aave or Compound and these kind of protocols don't sit rightly, to be frank. So
yeah, I absolutely think that the existing incumbents in the crypto space, the crypto natives who pioneered this, as well as ones who are currently building / are in their like infancy, will be very active. in the RWA finance space. That doesn't mean that the banks aren't going to try to also get involved in the space. I think they recognize the potential. I mean, just to contextualize, I think Aave has something like 30 billion in outstanding loans on Ethereum, right? Like, the firm I used to work at, Bridgewater, I think they're a $150 billion firm. So if they wanted to finance their book, it would be several times the size of all existing loans on Ethereum on Aave if they wanted to take one turn of leverage. That's how large the real world asset opportunity set is when TradFi comes. There isn't necessarily enough money in DeFi today to finance the big players coming on chain for all of their needs. So I do actually think the banks will play an important need. Also, they have access to interbank financing that you can't directly get access to on chain. That will still be important. I don't think the securities lending business is going to completely get gutted overnight. I just think that it's going to become more democratized, more effective, and a lot of it will move on chain. But since a lot of the existing capital rails are still TradFi, you need regulated parties who have access to the legacy system to be able to bring capital, mark it up just a little bit, but still way less than what we're currently paying, and put it into the DeFi ecosystem. The great thing is, to end that note, every one of these banks that's public, they are trying to generate shareholder value. Everyone that runs a trading desk is trying to maximize their P&L so that they individually get paid more. So when they see an opportunity and they say, okay, great, I can go and borrow interbank at 3.5% or 4%, let's say 4%. And today I can go and lend dollars out on this lending protocol for 5.5 or 6. I don't think that they're going to sit on their hands. I think they're going to say, I want to capture that. 2% is 10 times the spread that I am currently making working with the traditional financial institutions, where I'm fighting for bips and tens of bips. Let's go take that opportunity before one of our competitors does. So we just need the banks to get on chain. We need the large financial institutions to have the pipes and rails. And then the free market is going to create a very efficient system that I think benefits the incumbents materially. So whatever they need to effectively get there, as long as it doesn't hamstring the rest of the industry, I think we do it, because then there's no going back. Like, we've reached a transformational era.
Yeah. So Matt, I know we have taken a lot of your time. This is going so good today. I really have more questions, but I have just last question to you. I mean, because essentially you are right now one of the largest Ethereum holders, to be frank. I mean, in our language, you are one of the largest Ethereum holders today. And in terms of performance, there was a lot that was expected from Ethereum in the last year, 2025. And again, as I said, there was a tectonic shift in October 2025, after which it seems that liquidity has quite dried up. It seems that there is no more buying powder in the market right now. Do you see things changing in 2026, or do you see that it might take more than that for Ethereum to actually start outperforming again assets like gold or maybe silver?
Oh, I do see things changing in 2026. And I think if you look at gold and silver, it actually shows how much appetite there is for risk, stores of value, etc. I truly believe that a lot of the crypto speculation is agnostic to asset. And so if commodities are the thing that are super high volatility right now, people are trading that. That's fine. But the investors haven't gone anywhere. They simply are awaiting clarity as well as rebalancing post 1010. So if 1010 looked a lot like FTX, not from a cause, but from a deleveraging perspective, it took a few months for people to take stock of the situation, for OTC desks to pare down loans. It didn't sound like anyone in the industry that at least I thought was systemic took on material losses that would be cause for concern, which is what makes this so different in a positive way from FTX. But the deleveraging itself looked almost the same, right? An instantaneous loss of wealth. People have to go and repurchase their collateral assets, the Bitcoin and ETH, the high quality collateral assets that were used for margin if they got liquidated. Market makers couldn't get access to the market, so they had to then go and repurchase some of the deltas that they were missing. And then people slowly rebuild their positions. It takes time. What I do see is a lot of tailwinds to the market. We still have a Fed that is in liquidity mode, even if they're not going as fast as some people want. We have a strong economy and they're in liquidity mode. Like, that's a great pairing. We're getting clarity. We're getting institutions every day saying we're coming, it's happening. So I don't think we have an issue on all of those tailwinds. You simply have a short-term momentum fatigue. Like, it takes a little bit of, I would say, flywheel for our industry to catch a bid. People, at least the active traders, are looking to trade things that are moving and are interesting. And right now, there's a lot of mind share in metals. I do think that when the bid comes to Ethereum from all the institutions who have already said out loud we're doing it, it happens swiftly. And a lot of people are going to be caught off sides because, quite frankly, the best time to buy most of these assets is when everyone is writing off that, people are done with the trade. And that's what we effectively have seen post 1010. So I'm extremely bullish on 2026. I think there's so many things going for us. I can't remember a period actually historically where there have been so many positive things. I mean, just a year ago, we were afraid at any given day that a protocol was going to get a Wells notice, that the administration was going to randomly try to smite basically an entire value prop out of existence. And today we've got everyone saying we want to be a crypto powerhouse, and here's all the rules that you've been asking for the longest time. So I just think that it's a bit of everyone took a wealth shock and now people rebuild, and they're currently focused on things that are moving more situation.
Thanks, Matt. Thanks a lot. I mean, we have had quite a good discussion today, and I'm sure whosoever is listening and whosoever will listen to this podcast, they will learn a lot. And 2-3 questions that we asked you are actually quite popular in terms of our audience. Questions like, how should we select in terms of an underlying asset versus a particular stock representing a DAT? So thanks for asking these questions, Matt, and hope to see you soon. Have a nice day.
Really enjoyed chatting with you. Thank you.